Hey traders, in this video we're going to talk about a mean reversion traders toolkit. So if you like to trade mean reversion, stay tuned. Hey traders, a very warm welcome to you. Okay, so if you're a mean reversion trader, what tools or what indicators and what do you look at to really give you that idea that potentially things are running out of steam and we're looking for that retracement back? Just as a brief one, guys, the difference we've got here between a trend trader and a mean reversion trader or a volatility expansion trader, we can label them different things. But we've got this kind of scenario here, and a trend trader would look to for the market to continue going. You know, sometimes people call them inside out traders, range expansion, breakout traders, whatever that is. A mean reversion trader is someone who sees the same thing and looks to fade it coming back to some kind of mean. That's why it's called mean reversion. And the mean could be a volume weighted average price, it could be a moving average, it could be a support level or resistance level. The point is you're trying to find the area or price level where things just get a little bit too stretched and you're fading the trend. Now, just word of caution, mean reversion doesn't mean standing in front of a freight train. Doesn't mean if you see a monster trend just going short and hoping it's going to reverse. Mean reversion, you want to be cautious about using on a trend day, if at all. And in fact, that will kill you more than anything. If you're day trading and it's a trend day and you're trying to short, stop. It just causes, damage that you don't need. But if you're in a range bound environment, you're chopping around, you're kind of doing this, you're up and down, you're moving around this two-way trade, then bolting in a mean reversion strategy works very, very well. Okay, so what are the kind of things that we want to use if we're a mean reversion trader? Let's get rid of some of this stuff. So the first obvious one for indicators is to be using oscillators. So rather than moving averages or anything that are more trending, which generally in a mean reverting environment aren't going to be very useful for you, because a moving average will cross over, but it crosses over so late the mean reversion is almost done. So you may use a moving average to kind of dictate the mean, but to trigger an entry, probably not. So you're going to be using stuff like oscillators. That's going to be your relative strength index, your RSI, your stochastics, anything like that. And again, these are going to be oscillating between 0 and 0, that kind of thing. So when the price gets to a high level, these are going to come into an overbought condition, an oversold condition. And the theory being is that, when you're in an oversold condition here, I'm just going to put oversold, OS, an overbought condition here, is that it's time for the market. It's gone a little bit too far and it may well roll over. Now, that is one way of kind of filtering out things and saying when we get under or over these key levels, I'm going to look for a mean reversion. Then you want to kind of bolt in chart patterns with that. So you don't really want to just rely on this altogether, but you want to bolt in chart patterns in there. And some chart patterns that you can bolt in are things like divergences, okay? And that basically is saying, okay, if we've gone to a new high and we've gone to maybe another new high here on price, but your stochastics or your RSI hasn't gone to a new high, then this is a divergence because this is a low and that's not gone to a high. That may be a signal to go a mean reversing and say, hey, you know what? That's running out of steam now. We're not quite as aggressive on the stochastics. We're way away from our mean, whatever that may be, a moving average or even a kind of midpoint of the day's trade. Another way of doing it is to say, what's the average range of the day? Use your ATR and say, okay, 100 points. We've now stretched kind of 230 points and we're X away from the midpoint. Maybe I use my midpoint as a mean reverting tool and I use some oscillator like my RSI, like my stochastic, that kind of thing. Bolt it in with a divergence or even bolt it in with a traditional support and resistance play. Here we come up to resistance and the stochastics is overbought. And we're kind of with our range as well. Another thing to add is ATR on here. Very, very handy tool. That's the sort of thing you can say, well, the normal in inverted commas is X ticks, is X pips, is X points. We are now at the normal level. We're a normal day as well. There's nothing unusual about it. It's not non-farm payroll day. It's not this, it's not that. So normally, again, I'm using this, I'm exaggerating the word normal because obviously the market can do whatever it wants, but normally speaking, or most times when this happens, we will revert back and we won't go much higher. So you can then say, right, where are we on an oscillator, whatever oscillator you're using? Have we got a divergence with price? Is price pushing higher? Are we weakening off? You can obviously use that with volume as well. If you've got kind of volume data coming from the stock or whatever it may be, but you kind of add these little bits in and give yourself a signal to say, well, you know what, we've got a good chance of reverting back to a mean here. And like I say, a mean can be, a VWAP is a very good mean, and that's worth investigating a little bit more if you're not familiar with that. Moving average, again, some sort of moving average when we're pulling back to moving averages, because markets will, they'll look for new levels. They will then backfill, they will consolidate, they will look for new levels, they will backfill, they will consolidate. And your job as a mean reversion trader is to wait for that level where they just stretch too much, just run out. Supply demand is just at full tilt and about to swing back. And now some people say, hey, catching the end of trends is a dangerous game. And yes, as from the earlier kind of drawing you had up here, if you're a brutal trend day, you're not going to be mean reverting. However, you can still say, well, when we start to transition into a little bit more of a two-way environment, then I will kind of use these tools and bolt them in to those conditions and make good profit from it, while other people are still trying to catch trends. So there's some sort of tools that you can use if you're a mean reversion trader, guys. It's a very good way of trading because most of the time markets aren't always trending. There's always something that is range bound, has got a decent range as well that you can get involved in. Not to be kind of confused, final thing, not to be confused with choppy, which is just, candles that aren't doing much. There's a bit of two-way flow. It's not really going anywhere. Mean reversion is more direction, stop, reverse, direction, stop, reverse. That's when you get the most kind of juice out of the market when you're in those kind of conditions. All right, guys, take care. Main thing of everything, keep the risk managed. I will see you in the next one. Goodbye.